I'm here today with Professor Robert Shiller, Yale professor, Nobel Prize winner, author of one of our favourite books, Rational Exuberance, which is just out in its third edition, so look out for that. We will put details up at the end. He's also the inventor of CAPE, which regular readers will know we are very, very impressed by and depend on a lot for our recommendations to you. And he is president-elect of the American Economic Association. So that's quite a long list, but I think what we're going to talk about now is slightly more simple than that long list of things. The first thing I want to ask you about, we were talking earlier about stories and how the economy is really just a series of stories, and it's a matter of interpreting those stories. Can we talk a little bit about what you mean by that?
Well, the human mind, the human brain, seems to be, according to some psychological literature, organized around narratives. We tend to base our thinking, especially thinking that motivates us and excites us, in terms of stories and typically human interest stories. Some people seem to be you want to know, you have a sense of identity, you want to know what is my life story. Most people have a sense that it's so interesting, my story, and they want to tell people about it. Yeah. But they actually do take motivation to act based on stories that ignite emotions, like, for example, envy. If you hear the story about someone who's done brilliantly investing, that is motivational.
Okay, so all these individual stories can create what we call a collective consciousness that makes whole nations or groups of investors behave in the same way, simply as basically a result of, I don't know, seeing property programs on television or this kind of thing. And that, as I understand it, is how you think perhaps bubbles begin to build. A
bubbles
story that's picked up by a large group of people at once.
Bubbles in financial markets are a special case of what sociologists have called social epidemics. And I think that I've started lecturing to my class out of medical textbooks. There's mathematical epidemiology textbooks. When you read those stories, they can be applied directly to the economy as well. So it's that ideas have contagion. There's what have been called thought viruses that spread from person to person, or memes, as Richard Dawkins called them. I think I've traced that idea back to the 19th century. But it's never really invaded the economics profession that feels that all this psychological talk is undignified. And they don't want to, they want to talk about central bank monetary policy, things that have a crisp sound to them. Although the profession is changing, there's more and more interest now in behavioral economics.
Yeah. And do you think that there is a story doing the rounds at the moment that has become part of our consciousness that is driving markets?
Well, there's a number of them. I was recently talking about Greece as a story. My first reaction in hearing about Greece is, what's the population there anyway? It's tiny, so it can't matter. Turns out it can matter because of the story it generates. Stories, the reader doesn't necessarily think about or know how big Greece is. Greece just sounds awfully important, doesn't it? It's the ancient origin of our philosophy and science, but it's really not that important to the European Union. But it's a story. I think that the European sovereign debt crisis is really an amplification of the Greek story. It all started there, and it didn't have to have all these repercussions if it weren't for the power of the story.
Okay, the power of this particularly bad story in one small area that then gets taken to represent the whole story, making it much worse than it really is.
Stories are especially powerful if they tap into our sense of identity. Who am I? Identity is an extremely important motivational force. People want to know, why am I a good person? Why am I better than others? Well, they wouldn't like to put it that way, but in reality, they're competitive. So the Greek story had something about Greeks being, I'm not saying that, I'm saying this is the story, about Greeks being entitled, thinking that they should be bailed out by other people for their own profligacy. That's a powerful accusation, and it's a story that ignites interest. But it also ignites fears that Greece might default. And then once you get on that line of stories, it amplifies to other countries as well.
And this gives an impression for the investor of Europe that is not necessarily correct. Again, you were saying earlier that the CAPE for Europe at the moment is half that of the CAPE for the US, the cyclically adjusted PE ratio. So the impression given is that Europe is worth half what America is worth, and that's not necessarily the case.
So when you think of American investors, what do they know about Europe? There was a recent study where random Americans were asked to find Ukraine on the map. And it was horrible. They have no idea. They think it's in Australia or something. Greece, it's just a story, and they start to think, well, it must be representative of Europe.
But the point being that it's pushed possibly valuations in Europe much lower than they should have gone. So if you follow your general idea that the CAPE is mean reverting, buying Europe even now,
I think Europe is
reasonable proposition.
Is a good investment now, and the U.S. is not so good. But of course, I could be wrong. This is all. I just can't imagine that American stocks should have twice the valuation of European stocks.
Now, in the first edition of Rational Exuberance, you talked about the stock market, and the second you talked a bit about the housing market, and the third one you were saying that there is a piece on the bond market. What does that tell us?
Well, the bond market is strangely high in value right now. And if you look at inflation index gilts here in the UK, they've been negative on and off for several years, even at 20 years. So people are willing to lock up their money for 20 years at a guaranteed negative return.
But this is something that is very much affected by quantitative easing. So it's very hard to tell what prices should be given the amount of intervention from central banks, which maybe.
Well, see, another way of putting the puzzle is, if I can borrow at a negative interest rate, man, I ought to be able to do something with that. The government should be borrowing, it would seem, heavily and investing in anything that yields a positive return. Wouldn't you think that the UK government could find more to invest in that would have some positive return?
It's very hard to find infrastructure investments that have long-term positive returns, though, isn't it?
Yeah. Now, incidentally, that comes back to another proposal that it's really Franklin Delano Roosevelt's proposal in 1942. No one remembers this. Or do you remember? You know what I'm talking about?
Not yet.
In 1942, President Roosevelt created a government agency called the Public Work Reserve. And what it was going to do was to take long-term planning for infrastructure projects that would hire the unemployed after the war was over to prevent another depression. But he recognized that these infrastructure projects don't just leap out at you. If you're going to build a new highway, do you know how long it takes to plan a new highway? And you've got to get legal permits. And so he said, let's do long-term planning. Unfortunately, the war was too much of a distraction, and the agency was just shut down. But that was the idea. And I've been advocating, and Professor Shubik at Yale has been advertising, let's do it again. Let's create a government agency whose charge is think big and spend money planning and getting permits and doing the soil tests. Let's think. That isn't happening anywhere. No country has that. So we're not thinking like investors facing a negative interest rate. And even the corporate sector, you might think, would be investing at a very high pitch. They're not. So something is amiss in our...
Well, is it that they don't want to borrow going into a deflationary environment?
Well, okay. Apparently something like that is inhibiting them. They are investing something. I don't have a complete story of why it is. It's a puzzle of our time. It's described as a secular stagnation regime. That's what you were saying, I guess, that somehow we're stuck in a horrible economy. Nobody wants to invest. There are no investment opportunities. Somehow I'm skeptical of that, but I can't prove that's wrong. I think that put me in charge of a public work reserve for the UK. I can find projects.
Projects that you can be sure will make us a long-term positive return. We have form on this, you know.
Well, okay. Anyway, I shouldn't be so arrogant as to say I know, but it's a puzzle of our time that apparently can't be done. How can it be that there aren't projects like that?
Now we should go back to investing.
Sorry.
One of the reasons we're talking today is that you've just designed a new ETF with Barclays,
Right.
which uses your CAPE work on a sector basis to create effectively an ETF that combines momentum and value.
Correct.
Right? And can you just tell me a little bit about it?
Yes, well, it's a variation on the value investing idea. Value investing has often used price to book value of a stock. And they do individual stocks. They create a portfolio of supposedly undervalued, and apparently they are undervalued because value investing has now a long history of success. We have a different way of looking at it, using sectors instead of individual stocks. That turns out to be we pick low-priced sectors based on this CAPE ratio that I've developed.
And when you developed it, you didn't think about it in terms of sectors, did you? It was purely thought about in terms of
Right.
countries. So this is a departure for the work on CAPE.
Back in the 1980s, when John Campbell and I developed CAPE, we only applied it to whole countries. Now we are working on sectors, right? But it's the same idea. It's still not drilling down to individual stocks. Though I don't think the CAPE method works as reliably on individual stock. We need some modification of the method. The CAPE ratio is real price divided by 10-year average of real earnings. But many individual stocks don't even have earnings, or they don't have a 10-year history. And even if they do, it's very uneven for a single company. So
But it works for sectors.
It works for sectors.
So the way this works is, as I understand it, you pick the 5 most undervalued sectors in the market, chuck out the one with the least momentum, and so the index always has four undervalued sectors in it.
That's right, yeah.
And we were asking earlier, someone asked you earlier if you would do that for countries.
Yes, that was the original idea, to do it for countries. We are still working on that. The sector index seemed, for various reasons, to be the thing to launch first. When you get into countries, you have to deal with exchange rate problems.
Can you imagine someone going out today and buying the 4 lowest CAPE countries?
Yeah, I can tell you what they are.
Okay, yes, please.
According to Barclays research, the lowest CAPE country in the world is Greece. It has a CAPE of something like 3.7, as of earlier this month. The second lowest is Russia, okay? And now, I'm not sure, Portugal and Hungary, I think, are the other two.
Okay, now would you personally be reasonably confident that if you bought a basket of those 4 stock markets and held them for a decade, you'd be richer, not poorer at the end of that decade?
No, I'm not reasonably confident. So I think, though, that I'm confident enough that what I've actually done is, you picked the worst 4. I think the next one up is Italy. Okay. I've got Italy in my personal portfolio,
okay, so you
but I'm not
Italy,
over.
Spain, Portugal, or something like that.
Yeah, I have Spain too. Yeah. Spain. So I think they're Spain and Italy are very civilized countries with a long history of greatness. They've done amazing things in the past. But again, it's all as part of a diversified portfolio.
Of course. Now I can't let you.
Not of course. You wink when you say that. That's reality. That's what I do.
But no one ever finishes giving us a recommendation without saying as part of a diversified portfolio.
Well, it may be a cliche, but it's not. It's not just self-protection. You looked a little bit cynical about it. It's also people don't know that.
That's a look on my face.
All right.
No, I can't let you go without asking you if you have any views on the UK housing market, with which, of course, in the UK we are completely obsessed.
Yes, well, I think the remarkable thing is the similarity between the UK housing market and the US housing market. If you take a plot of London home prices and Boston, for some reason, Boston is the closest major city to London, and it looks pretty much the same.
But the London market is very different to the UK market as a whole, or certainly has been during this cycle.
And the same thing would be true, I guess, of Boston versus... They're both intellectual centers. They're both conservative people who don't go on wild flings, I think. Boston, you know, Boston proper, have you heard that? It's just, that's a term. Boston people are very proper. And so are Londoners. At least they used to be.
So prices in Boston and in London are at a level where you think they should come down, where they will come down?
Well, now, I'm not as clear on London, but in Boston they've gone way up and they've come way down and they're going up again. And that's sort of London too, yeah. Our latest data on it is showing slight declines in Boston.
Okay, so you're not buying any houses in Boston at the moment?
See, this is the thing about, well, I just helped my son buy a house in Boston. I think that we did that right because he just got married and they want to. That's more important. I don't know that I have any strong forecast for Boston or London. It's not in an intense bubble phase right now.
Well, thank you very, very much for talking to us. We really appreciate it.
My pleasure.
Cash is actually going to be a very good investment because under deflation, the value of cash goes up every day. And the other thing about this, what we're looking at today, people who remember 1973 and the oil price shock of the Arab oil boycott, that was the day, almost, you know, those few weeks where people suddenly got the idea, you know, what I ought to do is I ought to borrow as much as possible and I ought to buy as quickly as possible.